Imagine you walk into a bank and deposit $1,000. You probably think your money is just sitting safely inside a vault, but that's not what happens. The moment you deposit your money, the bank starts using it to make even more money. In fact, that same $1,000 could help the bank earn thousands of dollars, while you might receive only a few dollars in interest. So, where does your money actually go? How do banks make billions every single year? And what would happen if everyone suddenly wanted their money back? Let's find out. Before we answer those questions, you need to understand one thing. Banks don't make money by simply storing cash in giant vaults. If they did, banking would be one of the least profitable businesses in the world. Instead, banks have turned money into a product. Every dollar that enters a bank becomes an opportunity to generate even more money. And here's the surprising part. The money you deposit doesn't just belong to you anymore, it becomes part of a massive financial system that's constantly moving, lending, investing, and creating profits every single day. By the end of this video, you'll understand exactly what happens to your money after you deposit it, how banks earn billions of dollars every year, why they don't keep everyone's cash inside the vault, and what really happens when people wish to withdraw their money all at once. So let's start at the very beginning. You walk into a bank with $1,000 in your hand. Chapter 1: What really happens when you deposit money. So you walk into a bank with $1,000 in cash. You hand it over to the cashier, they count the money, process the transaction, and your account balance now shows $1,000. Simple, right? Well, not exactly. Most people imagine that their exact $1,000 is placed inside a vault with their name on it, waiting until they come back to withdraw it. But that's not how modern banking works. In reality, once your money is deposited, it becomes part of the bank's total pool of funds. Your account still says you own $1,000, and you can usually withdraw it whenever you want, but those exact bills are no longer sitting there waiting for you. Instead, your deposit joins millions of other deposits from customers across the country. Together, this creates an enormous pool of money that banks can use to run their business. Think of it like a giant water tank. Every customer pours a little water into the tank. Once it's inside, you can't tell which drop belongs to whom, but everyone still has the right to take out the amount they deposited. Money inside a bank works in a very similar way, and this is where things get interesting. The bank doesn't just let the enormous pool of money sit there doing nothing, because idle money earns nothing. So instead, the bank puts that money to work. But how can a bank use your money while still promising that you can withdraw it whenever you want? That's where the real business of banking begins. Chapter 2: The secret behind every bank. So how can a bank use your money and still allow you to withdraw it whenever you want? The answer is something called fractional reserve banking. It might sound complicated, but the idea is actually very simple. Let's go back to your $1,000 deposit. The bank knows that not every customer will come to withdraw all of their money on the same day. Some people won't touch their savings for weeks, months, or even years. Because of this, the bank doesn't need to keep the entire $1,000 sitting in cash. Instead, it keeps only a small portion in reserve to handle normal daily withdrawals. The remaining money can be used to issue loans. For example, someone else might walk into the same bank looking for a loan to buy a car, start a business, or purchase a home. Instead of using the bank's own money, the bank lends out money from the pool of customer deposits. This is why your money never really stays still. It keeps moving through the economy, helping businesses grow, families buy homes, students pay for college, and entrepreneurs start new companies. And every time the bank gives out one of these loans, it earns interest. That's where the real profits begin. But here's the part that surprises most people. The bank doesn't need to own all the money it lends. As long as it keeps enough cash available for everyday withdrawals and follows banking regulations, it can continue lending the rest. This system has powered modern banking for centuries. But it also creates an important question. If banks are lending out so much of the money people deposit, how do they actually make billions of dollars from it? Let's break that down next. Chapter 3: How banks actually make billions. Now that we know banks lend out a large portion of the money people deposit, the next question is obvious. How does that turn into billions of dollars in profit? The answer starts with one simple word: interest. Imagine you deposit $1,000 into your savings account. The bank promises to pay you 2% interest each year. That means after 1 year, you earn $20. Sounds fair, right? Now imagine the bank lends that same money to someone buying a car at 8% interest. On a $1,000 loan, the bank earns $80 in interest. It pays you $20, keeps the remaining $60, and that's before considering its operating costs and other expenses. This difference between what a bank earns on loans and what it pays to depositors is called the interest spread. And this is one of the biggest ways banks make money. But that's only the beginning. Banks don't just give out car loans. They provide home loans worth hundreds of thousands of dollars, business loans that help companies expand, education loans for students, and personal loans for everyday expenses. Each of these loans generates interest month after month, year after year. Now imagine this happening not with one customer, not with 1,000 customers, but with millions of customers.
Even a small profit on every loan adds up to enormous amounts of money. And banks have another advantage.
Every time an old loan is repaid, that money can often be lent out again to someone else, creating another opportunity to earn interest. But loans aren't the only source of income.
Banks also earn money from credit card interest, loan processing fees, account maintenance charges, overdraft fees, foreign exchange services, investment products, wealth management, and business banking services.
Each individual fee may seem small, but when millions of people use these services every day, those small amounts become billions of dollars in revenue every year.
So while many people think banks simply store money,
their real business is making money move.
Because in banking, money sitting still earns nothing.
Money in motion creates profit. Chapter 4: What happens if everyone wants their money back?
Now think about this for a moment. If banks have already lent out a large portion of the money people deposited,
what happens if everyone walks into the bank on the same day and asks for their money back? The answer is, the bank probably wouldn't have enough cash. Not because the money has disappeared, but because much of it has already been loaned to other people who are expected to repay it over months or even years. This situation is known as a bank run. Imagine one person hears a rumor that their bank is in trouble. They rush to withdraw their savings. Other people see what's happening and start to panic. Soon hundreds of customers are standing outside the bank, all trying to take out their money before it's too late. The more people panic, the faster the problem grows. Ironically, a perfectly healthy bank can collapse if enough people lose confidence at the same time. History has shown this more than once. During the 2008 global financial crisis, fear spread through financial markets around the world.
Several banks failed, governments stepped in with emergency support,
and many countries
strengthened banking regulations to prevent similar crises in the future. That's why modern banks are required to keep reserves, follow strict financial rules, and in many countries, customer deposits are protected by government-backed deposit insurance up to certain limits. These safeguards are designed to make sure people don't panic and rush to withdraw their money all at once. Because in banking, confidence is just as valuable as cash.
As long as people trust the system, it continues to work.
But there's one final mystery left to solve. If banks can lend money, earn interest, and keep the economy moving,
are banks actually creating money out of thin air?
The answer is more surprising than you might think.
Chapter 5. Are banks actually creating money? At this point, you might be wondering,
if banks keep lending money that people deposit,
are they actually creating money out of thin air?
The answer is, in a way, yes. Here's a simple example. Imagine you deposit $1,000 into a bank. The bank then lends most of that money to someone who uses it to buy a laptop. The laptop store receives the payment and deposits that money into its own bank account. Now that bank also has a new deposit, it can lend out a large portion of that deposit to someone else. That person spends the money, another business deposits it, and the cycle repeats again and again. The same money keeps moving through the economy, supporting more loans, more businesses, and more economic activity. This process increases the amount of money circulating in the financial system, even though the original cash deposit was only $1,000.
Of course, banks can't lend unlimited amounts of money.
They must follow regulations set by central banks, and financial authorities maintain enough reserves and meet strict capital requirements. Without these rules, the financial system would become far too risky. So, are banks printing money like a government? No. Only a country's central bank has the authority to create physical currency. Commercial banks don't print new cash. What they do is create new lending opportunities that expand the flow of money throughout the economy. And that's one of the biggest reasons modern economies are able to grow. So the next time you deposit money into your bank account, remember this. Your money isn't just sitting quietly inside a vault. It's constantly moving through the economy, helping people buy homes, start businesses, fund education, and keep the financial system running. And along the way, it's helping banks earn billions of dollars every single year. Chapter 6: Conclusion. So let's go back to the question we asked at the beginning. How do banks make billions of dollars every year? The answer isn't magic. And it isn't because your money is locked away in a giant vault. Banks make money by putting money to work. They collect deposits from millions of people, lend a large portion of those funds to borrowers, earn interest on those loans, charge fees for financial services, and keep the entire system moving.
As long as people trust the banking system, that cycle continues day after day, year after year.
In fact, every time you deposit money into your bank account, you're becoming part of a financial network that powers businesses, helps families buy homes, funds education, and supports economies around the world.
So the next time you check your bank balance, remember, your money isn't just sitting there, behind the scenes. It's part of one of the most fascinating financial systems ever created, and that's how banks make billions.
If you enjoyed this video and learned something new, make sure to like the video, subscribe to the channel, and let me know in the comments, what financial topic should we uncover next?
Thanks for watching, and I'll see you in the next one.